Welcome everybody to the Family Law Software webinar on the American Rescue Plan. My name is Dan Kane. I'm the president of Family Law Software. And as many of you know, we have implemented the tax provisions of the American Rescue Plan in our code. And the process of implementing those provisions gives us a deep familiarity with them. So it is on that basis that I speak to you this morning about the provisions of the American Rescue Plan. The plan was signed into law on March 11 of this year, and it enacted big changes. First of all, there was a stimulus payment, technically a tax credit, changes in the child tax credit, changes in the child care credit, changes in the earned income credit. But just for 1 year, most of the changes in the plan are for 2021 only. So what we're going to do today is we're going to talk about the changes and strategies that you as divorce professionals can adopt to help your clients make the most of them, because most of these changes will be beneficial to the clients. So the changes primarily occurred with respect to three credits: the child tax credit, the child care credit, and the earned income credit. And we will be talking about those three credits, and then we will suggest strategies that practitioners can adopt to deal with them. So although these changes are for only 1 year, President Biden has released a proposal called the American Families Plan that proposes extending these changes through 2025. And I will be mentioning this from time to time as we go through today's session. But for the most part, and in current law, these changes affect 2021 only. So we'll begin by talking about the child tax credit. The American Rescue Plan increases the child tax credit, also known simply as the child credit. In general, the credit is increased from $2,000 to $3,000 per child, but only for 2021. And there's more. For children under the age of 6 at year end, a bonus $600 is added to the child tax credit. And children who turn 17 in 2021 now qualify. Previously, you would only qualify up to turning 16 in the year of the credit, so in 2021. And again, all this is only for 2021. And still more, the child tax credit is now mostly fully refundable. So the child tax credit for children aged 17 and under is fully refundable. The phase out is more generous for higher income taxpayers than it was. And again, all this for 2021 only. So say you have 2 children, ages 1 and 3. The child tax credit now is 2 times 3,000 plus 600, or 2 times 3,600, or 7,200. And previously it was $4,000. So really dramatic. And let's take a moment and talk about what fully refundable means. Fully refundable means that even if there is no tax liability, the government will write you a check for the full amount, or for whatever amount is refundable, in this case, the full amount. Before and after 2021, the child tax credit is only partially refundable. Up to $1,400 of the $2,000 was refundable, depending on many factors, including incomes. For example, before and after 2021, if the party's income is less than $2,500, the credit is not refundable at all. And the credit itself phases out at higher incomes. You'll see also that the first bullet point here mentions the child tax credit for children aged 17 and under is fully refundable. There is a second piece of the child tax credit, which is $500 per child which applies generally speaking to children who are over the age of 17 in 2021, but still dependents. That second piece, that $500 piece, is not refundable. So just the big piece, the $3,000 or $3,600, is refundable. Just want to take a moment and mention we will be monitoring the Q&A, but not the chat, and we will not be able to respond to hand raises. So if you have a question at any point, go to the Q&A. All right. This chart on this page shows the child tax credit by income level with 2 children, with and without the American Rescue Plan. So the red line here is the child tax credit with the American Rescue Plan. Along the vertical axis, we see the credit amount. On the horizontal axis, we see incomes. So the child tax credit stays at the very high $7,200 amount until the incomes hit for a head of household $112,500, and then it starts diminishing, and then it joins the old credit here. This line is actually purple beyond this point here, and then it continues to phase out as it did before the American Rescue Plan. Note that for a large range of incomes, the credit for these 2 children is $7,200 versus what it was before, $4,000. For the head of household filing status, the phase out begins at $112,500. The slope is $50 of credit loss for each $1,000 of income, which is the same slope that you'll see that occurs at a later point prior to the American Rescue Plan and with the American Rescue Plan for the higher incomes. The American Rescue Plan phases out, under the American Rescue Plan, the child tax credit phases out completely at an adjusted gross income of $280,000. And this is looking at the head of household. If the person is filing a joint return or as a surviving spouse, the phase out starts a little higher at $150,000. And if the person is single or married filing separately, it starts lower at $75,000. So with the child tax credit, advance payments are planned. You may have read about this. It was just an item in the news this week, but the concept was incorporated in the American Rescue Plan as it was passed in March. The IRS is planning to start making advance payments of the child tax credit on July 15th. And the advance payments are going to be 1/12 of the anticipated credit each month. So that would be up to $250 per month for children ages 6 through 17, up to $300 per month for children ages 0 through 5. So multiplying by the 6 months, the taxpayers will receive a maximum of $250 times 6, or $1,500 for children ages 6 through 17, and $300 times 6, or $1,800 per qualifying child by the end of 2021. Families with higher incomes who are phased out will qualify for reduced credit, and they will get 1/12 of the anticipated credit amount. So for example, if the credit is phased down to $2,000 instead of $3,000, those households would get $167 per month. So the mechanics that the IRS is planning is that these payments will be like stimulus checks. They will be made as direct deposit, as checks, and as debit cards, depending on how the IRS is able to reach the taxpayer. In order to determine eligibility, the IRS will look at children that were reported on the 2020 tax returns, and presumably the exemptions claimed on the 2020 tax returns. If a 2020 tax return has not yet been filed, the deadline just passed. But if the tax return has not yet been filed, the IRS will look at 2019 tax returns. And these tax returns have the birth dates of the children, so the IRS will be able to compute the ages and eligibilities. And the way it works is that the 2021 tax returns, which people will be preparing in January through April of 2022, will show the tax credit and then reduce that tax credit by the advance payments received. So for example, if a family or a household qualifies for a $3,000 credit and they received $1,500 in advance, they will get an additional credit of $1,500, the remaining $1,500 when they file their tax return for 2021. So more on the mechanics. If you have a client who earns little enough money that that client did not have to file a tax return in 2020, but the client has a dependent child for whom the client claims an exemption, you might want to advise that client to file for 2020 now, even though it's late, report the slight income, report no tax due. That will get the return into the IRS's system, and fingers crossed, all goes well, that will qualify that client to start receiving the advanced child tax credit payments now. So that's a small strategy item that you can add to the strategy items that we're going to be talking about today. Treasury Department and the IRS say they will continue efforts to make families aware of their eligibility. And finally, the IRS is hoping to make it possible for people to opt out of those payments if they want to. This will be through a web portal, a web page the IRS is working, one imagines, feverishly right now to create. And on this web portal, in addition to opting out, so why would you opt out if you did not want to get the $250 or $300 per child payments from July through December? You really wanted to get that big slug when you file your tax return next year, you could opt out. So on the portal, people will be able to make updates to their income because the credit eligibility depends in part on income, filing status, and number of children, most importantly. And my guess, I have not read this or heard this anywhere, but knowing what I know about software, my guess is that creating a portal that takes this information from people is pretty easy. The hard part is making that portal interface with the existing IRS software, which is mainframe software that was developed in the 1960s. They've had multiple modernization projects, but never quite, I think, rolled out a new system. So that I think is the challenge. So we should have compassion for the IRS people who are laboring over this. Also, they will have to work on minimizing fraud. The Earned Income Credit program is beset by fraud. The IRS has estimated that in 2019, it paid roughly $7.2 billion in credits that were improperly paid. Most of that is probably the Earned Income Credit, which is an advanced credit like this one. All right, so we've seen that the child tax credit is going to be a lot larger this year. Let's refresh our recollections with respect to who gets to claim the child tax credit. The child tax credit flows to whichever party claims the tax exemption. This is something that can be negotiated, and if the parties negotiate, and in the context of a divorce, can be negotiated, and if the parties negotiate that the minority time parent will be claiming the exemption, then what has to happen is that the majority time parent has to file an IRS form called 8332. It's a very simple form. You basically just list your name, social security number, and the information that you are waiving the exemption. On that form, you have the option to waive the exemption either just for 1 year, which might be what you're doing in this case, or for years that you specify, or for all years. This is one of this ability to negotiate who claims the exemption and thus who gets the child tax credit is one of the few cases in tax law where the tax law actually allows you to game the system. You are allowed to negotiate the claim of exemption to whichever party benefits most. And this has an important implication for strategy, which we will get to later. So that concludes our exposition of the changes that occurred with respect to the child tax credit. Now let's look at the second credit that changed significantly under the American Rescue Plan, and that is the child care credit. The change to the child care credit is even more dramatic than the change to the child tax credit. The maximum child care credit is now $8,000 if there are 2 or more children, and the child care credit is fully refundable for 2021. Now, the child tax credit is received just on the basis of having dependent children. The child care credit is the tax code's bid to partially subsidize child care expenses that a party paid. So before we dive into what changed under the American Rescue Plan, let's look at what didn't change. First of all, the child must be under the age of 13 when the care is given. The child must live with the payer more than half the year, and there are other requirements relating to relationships between care providers and the family. The idea is not to have relationships. The purpose of those other requirements is to prevent people from getting a tax credit for care that is provided by family members. These provisions are the general ticket of admission for the child care credit, and the American Rescue Plan does not change any of these requirements. So let's look at what did change. First of all, expenses in the child care credit calculation now count up to $8,000 for one child or $16,000 for 2 or more children. And the credit is now 50%, up to 50%, but in most cases will be 50% of those expenses. So the maximum credit is $4,000, which is half of $8,000 for one child, or $8,000, which is half of $16,000 for 2 or more children. So let's just note, if you pay expenses beyond the maximum, so if you have 2 children and you pay $20,000, only the first $16,000 is relevant. And if you pay daycare for more than 2 children, there's no additional benefit for doing that. Now, previously, expenses could qualify could be considered up to $3,000 for one child or up to $6,000 for 2 or more children. And previously, and subsequently, since again, this is a 2021 only change, the maximum credit was 35% of those expenses versus 50% in 2021. And so the maximum credit previously was 35% of $3,000 for one child, which is $1,050, or 35% of $6,000 for 2 children, which is $2,100. So the maximum credit now at $16,000 is almost 4 times what it was at $2,100. It may also be worth noting that the average childcare cost in the United States is around $1,300 per month. And the maximum here of $4,000 per year per child computes to $333 per month. So if the parent is paying the average daycare cost, in 2021, the government is paying about 25% of the total cost of daycare. If you have 2 children in daycare and manage somehow to keep the total cost to $1,300 per month, the government is paying half of your daycare cost. This is really quite dramatic. And there have been statements from the administration that this act will dramatically reduce child poverty. And I think that this provision, this child care credit provision, is the active provision that is going to do this. This amounts to a social policy of supporting working families engineered through the tax code. But again, 2021 only unless extended. The child care credit for 2021 is also fully refundable. Before and after 2021, the child care credit is not refundable at all. And what that means is that if you owed no tax, then you got no benefit from the child care credit, and many lower income people got no benefit from the child care credit before now. So really, the child care credit was not in the minds of people like us, divorced professionals, and at least for 2021, it really should be. The effect of the child care credit is a payment of up to $8,000 in cash to a family that pays daycare. And there is a planning point related to this, which we will discuss later. Now, the child care credit still phases out for higher income taxpayers, but the phase out in 2021 still leaves significant credit at high incomes, and the credit actually phases out to zero for very high incomes. And let's see this. So this chart is the child care credit by income for one child. So along the vertical axis here, we see the credit amount, $4,000, assuming the maximum expenditure of dollars in daycare. So you see the credit is up to $4,000 with the American Rescue Plan. Before it was $1,050 and started phasing down immediately. Now the credit doesn't start phasing down until a much higher income point, phases down, and then continues at about $1,600 until incomes hit $400,000. Previously it phased down to around $600 and continued indefinitely. Now there is a further phase out for taxpayers earning more than $400,000. Those of you who've heard the president speak about future tax increases have heard him use that $4,000 number as a threshold, below which he does not expect to increase people's taxes in any future plans. That $4,000 number is implemented here as the point at which the benefit of the child care credit starts dropping off. And in fact, the child care credit phases out all the way to zero for incomes over $438,000. Previously, even if you had incomes over $438,000, you still got some credit. So this is a nod in the direction of income equality. Just a nod, but a nod. All right, so those are the new provisions of the child care credit. Really, the bottom line is a dramatically increased credit currently applying for 2021 only. Now let's talk about the third credit that was affected in the Tax Act, and that is the Earned Income Credit. Let's talk about the Earned Income Credit in general. It gives payments to people who earn some income. The payments increase to a point and then decrease as income increases beyond that point. The purpose of the Earned Income Credit is to incentivize and reward people who gain full-time employment. So the payment increases as incomes increase up to that point. Beyond that point, it is felt that people do not need further incentives to gain employment. First of all, they have income itself. And so the Earned Income Credit decreases smoothly beyond that point. Historically, the Earned Income Credit has been a leading example of social policy implemented through the tax code. Just to give an example, for 2021, if you are a head of household with one child, the earned income that maximizes your Earned Income Credit is $19,520. So about $20,000 is the income that calls forth the peak credit, and the Earned Income Credit at that point is $3,000 $618. Beyond that, the earned income credit diminishes, and leading up to that, the earned income credit increases. So more details, this credit was designed always to be fully refundable, always designed to be a payment from the government, putting money in the pockets of the person who is employed. The credit increases with the number of children, up to 3 children. Beyond 3 children, there's no further increase. If you have no child, you may still be eligible for the credit if you are between the ages of 25 and not yet 65. And you may not claim the credit if you are married filing separately. This is one of a number of provisions scattered through the tax code that was implemented to discourage people from filing as married filing separately. The tax code encourages people who are married to file jointly. And this is again an attempt to prevent people from gaming the system by choosing whichever filing status yields the better result. The tax code was historically jiggered so that all or most joint filers would do better. Most married couples would do better filing jointly. All right, so what changed in 2021? First, if you have no children, the earned income credit increased dramatically. The maximum credit goes from $543 to $1,502. Also, if you have no children, you may be as young as age 19. Previously, the youngest age was 25. If you are not a student, if you are a student, the age 25 threshold still applies. For 2021, there is no upper age limit, right? It was 65. The Act recognizes that people over age 65 are low income and are working and could really use this boost. And for 2021 only, taxpayers have an option to use their 2019 earned income if that gives a better result than 2021 income. I will answer the question, why not 2020 income? I think most of you have probably immediately intuited the answer. It is probably because for many people, because of the pandemic, 2020 income was significantly lower than 2019 income. So you have the option to use 2019 income, which was probably the last year you were really fully employed. So that if you earn no income in 2021, you can get a double shot from your 2019 earned income. You can get the credit in 2020 and get the credit in 2021 as well. So this change, the change that it allows the earned income credit to apply to people as young as 19 acknowledges that 19-year-olds may be the people that are supporting themselves. They may need to work and they may still struggle financially. So this chart shows the earned income credit for 30-year-old single individuals with no children. This is the demographic for which the earned income credit really changed in a dramatic way. And you'll see that up to, and this also gives you a feeling for how that credit phases up and phases down as your income approaches that peak threshold. So with the American Rescue Plan, you see that it's around $1,500 is the peak, and it just increases smoothly until you get to that point from zero and decreases along pretty much the same slope until your income gets in the above $20,000 range. The Act also changed the earned income credit for people who are married filing separately. You may recall that the Act the law prior to the Act prohibited people from filing for the earned income credit if they were married filing separately. The Act now permits married filing separately individuals to file for the earned income credit, but only in very specific circumstances. First of all, you have to have lived with a qualifying child for more than half the year. Second, and significantly for divorced professionals, you have to have separated before July 1st or have signed a divorce or separation agreement and be living apart by December 31st. So this change, unlike the other changes in the Act, is permanent. So people who meet these criteria and file separately will be able to claim the earned income credit going forward. So one question may be, why is this provision of the Act permanent? And one thought might be that it is because it will have very little impact. Why will it have very little impact? Because most people who are in this group of people who separated before July 1 or signed a divorce and separation agreement, et cetera, will qualify as head of household. So the question arises, well, who would not qualify as head of household, would have to file separately and thus be benefited by this change? And the answer is people who are not providing more than half of their support, because one of the requirements for head of household is that you are providing more than half of your support. So this provision benefits people who are separated, who really need the support because they're not providing half of their own support. So something really to be aware of as you look at your separating clients. And one strategy that arises from this narrow provision, which I will mention right now, is that if you have a client in this situation and they had not separated by July 1, or they do not separate by July 1 of 2021, and we're getting into November, December, you want to get them to sign their separation agreement before the end of 2021 so that they can qualify for this earned income credit. As you have seen, it can be thousands of dollars for which they might not otherwise qualify. So an important strategy to think about as you are working with clients who may be lower income. I know that most of the people on this webinar are family law software subscribers, so I will mention that there is now a checkbox in family law software where you enter filing status that says, if you are filing separately, do you qualify for the earned income credit? We put that checkbox there in part to prompt you to think about this question. There's a help button there to explain the circumstances, and obviously we encourage you to check it if it applies. It will affect child support, so you want to get the right number, but also it will remind you to get that agreement signed by the end of the year. Okay, adding it all up. So these changes are arriving all at once. So let's consider a head of household with 2 children under the age of 6 who has the maximum, at least qualifying amount of child care expenses. The difference in credits from 2020 can be $3,200 for the child tax credit plus $5,900 for the child care credit, or $9,100 just from these 2 credits. If you add in the government stimulus payment of $4,200, you get $13,300 additional from the government. But just in 2021, unless some or all of these changes are extended. As an aside, it is worth mentioning that the focus of these tax changes is clearly on support for young families. The Act did not change tax rates or tax brackets generally, and there was no small business provision as there was with the last Tax Act. So we can see that the personal income tax provisions of this Act are focused clearly on young families, and particularly on young working families. So this concludes our review of the tax law changes themselves. And now we can ask, what are the strategic responses that we as divorce professionals can make in response to these Tax Act changes? We have 3 key strategic responses. First, negotiate a different child support amount in 2021 than in 2022 and later years. Second, if at all possible, have your client claim the exemption in 2021. And third, be sure that the majority time parent pays the daycare. And we will go through these strategies in some detail right now. First, two child support amounts, right? The stimulus payment plus the tax credits gives a very different income picture in 2021, as we have seen. I'll just digress to mention that just today, we released an update in family law software that gives you the option to see child support and after-tax cash flow and so on, with and without the American Rescue Plan. That has been there for months, but now also with and without the stimulus payment as part of the American Rescue Plan. So you have new options in the software, and they're explained. Anyway, the stimulus payments plus the tax credit gives a very different income picture in 2021. If federal income tax is a deduction for child support purposes, which it is in most states, but not all states, or the federal child care credit is a factor in the support calculation, these changes will affect the child support calculation, and the difference can be hundreds of dollars. Let's look at this impact on child support. We have a hypothetical case here, two children under the age of 6. Party A earns $3,000 per month. Party B earns $6,000 per month. The daycare is $1,300 per month. In that case, you will see the chart on the right, and this is also on a blog on our website. We've calculated what child support is. The first column is child support without the American Rescue Plan. Second column is child support with the American Rescue Plan. Third column is the difference. And you can see that the states with the biggest differences were Ohio at $455 a month, New Jersey at $416 a month, and Illinois at $401 a month. So the states where you get a $400 per month difference just by including the American Rescue Plan provisions. You can check it out and find out what we found for your state. And in family law software, you can easily check that American Rescue Plan checkbox. It's at the top of the child support screen, and see the impact on child support of including these American Rescue Plan provisions. So what's fair? Well, since the income is so dramatically different, right? We've seen that the government is paying thousands of dollars to taxpayers in 2021. It seems fair to include that income in the calculation of child support, at least for 2021. But under current law, that extra money is going to vanish in 2022. So it seems unfair to set permanent support based on that additional cash flow of those credits. So a solution, our proposal, something you might think of doing, is as you're negotiating agreements this year, negotiate two child support amounts, one for 2021 and one for future years. And click the checkbox that turns on the American Rescue Plan provisions and use that for your 2021 number. Clear the checkbox so you're not using American Rescue Plan provisions, and use that result for your number for future years. So now we've mentioned that the American Families Plan proposal proposes to extend these provisions 5 more years. What should we do if the law is extended? And you're negotiating today, right? And the agreement will be signed, and that will be it. So first of all, I will say that making a dramatic change for a single year is unprecedented in my 30-year experience working with taxes. So if you're out there scratching your head saying, you know, what is this? You are in good company, and it is not a surprising reaction. This is a unique thing to have such a dramatic change effective only for 1 year. So it may be extended. What do you do as you're drafting your agreements? Say that if the American Families Plan or a similar act is enacted that extends the provisions, the tax provisions of the American Rescue Plan, that the 2021 child support will continue to apply for those years. And further, what you can do is you can say, if the tax credit provisions similar to American Rescue Plan provisions, but not identical, are enacted, maybe specify that this is something that triggers modification. So you can't know what those things are going to be, but you know they may be dramatic. Specify in our agreements, we go back and we just recalculate because the incomes will be different and the numbers should be different. So that is strategy number one, specify a different child support for 2021 than we do for future years, and plan for possible extension of Act provisions. Strategy number two, be sure to claim the exemption in 2021. As we've seen, the tax exemption determines who claims the child tax credit, and the child tax credit is worth dramatically more in 2021 than it will be in 2022. So you want to be sure that your client is claiming that exemption in 2021. As we've seen, this can be worth $1,600 per child direct to your client's bottom line. If there are 3 children under the age of 18, with 2 of them under the age of 6, this can be worth an incremental $4,200 just by claiming the exemption. So as an aside, the 2017 Tax Act eliminated the tax adjustment for exemptions. And a lot of people after that thought, oh, it doesn't matter anymore who claims the exemption. But it always mattered for the child tax credit. And now that the child tax credit is turbocharged, it matters even more. So, so pay attention to who claims the tax exemption. Now, in a lot of cases, people negotiate to alternate the exemptions. And if you are negotiating an agreement that alternates the exemptions, you want to do everything you can to make it the case that your client goes first in 2021, that your client gets the exemptions to claim the exemption in 2021. The other client, the other party can claim the exemptions in 2022, and you alternate from there. As an aside, alternating exemptions can be a poor tax strategy. If both parties are in a similar tax bracket, then they both will likely get the same tax benefit from the child tax credit, and alternating the exemptions is fine. But if one parent is going to get a significantly larger benefit from the child tax credit than the other parent, you want that parent always to claim the exemption and then split the benefit with the other parent. And that is what this slide is about. If both professionals were on this webinar and are clued in to the importance of claiming the child tax credit, claiming the exemption this year, and there's a contest over who gets to claim the exemption in 2021, you can share the wealth. You can see calculate what the incremental benefit is to the tax credit in 2021, and just split that. Just provide that one party will pay the other party half the incremental benefit or something like that. So that is the second strategy, claim the exemption in 2021. And our third strategy involves focusing on who pays for daycare, who pays childcare. And the strategy is make sure that the majority time parent is the one that pays for daycare. So this is worthwhile as long as the child care credit is worth something, right? We have seen that in prior years, it was often the case, the child care credit was worth nothing because it was only worth it if you had net tax, and many low-income people have no net tax to pay. And recall from our description of the child care credit that the person who pays child care can claim the deduction only if that person is also the majority time parent. So you So if the minority time parent is paying childcare in 2021, you could lose that enormous childcare credit benefit for 2021 that we've been talking about. So you really want to be sure that the parent that pays childcare is the majority time parent. And remember, this can be up to $8,000 in 2021 direct to the bank account. So suppose that you're in a situation where the minority time parent has been paying daycare. You want to switch that around a little bit. You want to make it the case, and this is the case for clients whose cases are settled. You may want to reach out to them, let them know. For 2021 at least, have the minority time parent pay the majority time parent, have the majority time parent write the check to the daycare provider. And this would be dollar per dollar. So if the minority time parent was paying daycare of $1,000 per month, have the minority time parent write a check to the majority time parent for $1,000 per month and have that parent pay the daycare. Now, what about the situation of exactly equal parenting? If the parties have specified exactly equal parenting, the IRS, in its wisdom, will designate the higher income parent as the majority time parent. This is little known, but can be very important, especially in this situation. The impact tends to be that it reduces the credit payable because, and I'm going to be stereotypical here, the lower income parent is typically the mother, and the mother typically pays daycare costs. And if the IRS designates the father as the majority time parent, you would lose the child care credit entirely. Neither party would be able to claim it. So if you are in an exactly equal parenting situation, what you want to do is make sure that in practice, the child care payer spends, it can be 1 day more than the other parent per year, but make sure that the child care payer is the majority time parent, even if it is just by 1 day. And you can go ahead, first of all, in most cases, if you specify 183, 182, 183 overnights for the majority time parent, 182 overnights for the minority time parent, that will not affect the child support calculation. But if it does affect the child support calculation, and there are some situations where it would, then calculate child support on 182.5, 182.5, exactly equal parenting. But in practice, in the real world, make sure that the majority time parent, that the parent that pays the child care is spending 1 more day at least with the children than the other parent, so that you can claim the child care credit. So let's summarize those 3 strategies again. First, have a different child support amount in 2021 than in 2022 and later years. Second, have your client claim the exemption in 2021. And third, be sure that the majority time parent pays the daycare. So we've been talking about after-tax cash flows in the context of the American Rescue Plan. I just want to take a few minutes to make the point that it is always important to look at after-tax cash flows. This year, the tax changes are dramatic, but in general, taxes matter every year, and you should always negotiate with after-tax cash flows in mind. And what I'm going to do is take just a couple of minutes, and again, because I know that most of the people watching are subscribers to Family Law Software, I'm going to take a couple minutes to show you how you can easily be sensitive to after-tax cash flows in Family Law Software. So the first thing is a feature called Support Impact. It's on the Analysis tab of Family Law Software. Click Analysis and then Support Impact. It's the first option on that tab. And what that will show you is the impact of child support, spousal support, and taxes on both parties' bottom lines. And this is how the graph looks on that screen. And I'll just explain it a little bit. So there are 2 bars on the left and 2 bars on the right. The 2 bars on the left are the parties' gross incomes. This is before any child support, spouse support, or taxes. And the 2 bars on the right are the parties' incomes after, just after child support, spouse support, and taxes. And what this shows you and shows the parties is the impact of child support, spouse support, and taxes on the bottom line. Typically, this impact will be equalizing, and typically it can help the parties feel that the outcome is fair, or it will highlight if the outcome is dramatically unfair. So very useful graphic, very useful feature. And again, it's go to the Analysis tab and just click the first option on that tab. The second thing I want to talk about is the software's budget report. And you may be using the budget report for after-tax cash flows. It's worth doing, and also worth thinking about the budget report as something that shows the impact of taxes. So again, the budget report is, to get it, you click on the Reports tab and then Budget Reports, scroll to the bottom. And what it will show you, and this is the bottom half of the budget report, but you'll see that it shows all of the taxes, federal taxes, an estimate of state taxes, Social Security tax, total taxes, and you can see total income minus total expenses minus total taxes, and net income after taxes. So if you want to see, just have an easy way of seeing the impact of various tax decisions. So you change the exemptions, you change who pays childcare, you change wages, you want to see the impact of those things on taxes. Run the budget report before you make the changes, run the budget report after you make the changes, and see the difference and see the impacts. So again, very useful, very easy to use. And I will show, I think, one more tool in Family Law Software to help you with after-tax cash flows. And this is what we call Ask What If. It's on the Analysis tab, and it's several selections down. It's called Ask What If. And you can ask what if about exemptions, wages, filing status, all kinds of things. You can set up side-by-side scenarios, and then you can change child support, change spousal support, change wages, change exemptions, and see the bottom line impact after taxes. So all these things, many of these things have tax impact. And this is what the screen looks like, the what if screen. And what we have done here is we have changed just who claims the exemptions. In the first column, Taylor is claiming the exemptions. In the second column, Blake is claiming the exemptions. And then here you can see the net after taxes and expenses. Taylor goes from 927 to 694. Blake goes from 4274 to 4607. So really easy. I just went to the screen, changed one entry, and saw the after-tax impact. So it's really easy to see the tax impact, and this can help you help your clients make smarter tax decisions, can help you negotiate more effectively on behalf of your clients. So in conclusion, don't just stand there. The American Rescue Plan changes have not really been very widely discussed, but they are big, they are dramatic. There's a kind of a tendency to shrug your shoulders and say, oh, it's just 1 year, I'm not going to worry about it. Don't do that. It is big, it is very important for your clients who are negotiating settlement agreements this year, and even for clients that you've had previously that are living through this year. It's a dramatic thing that you need to react to. And moreover, it is a real opportunity. And if you seize this opportunity, you can make a big difference for your clients. And finally, important to do after-tax analysis for your clients in 2021 and always. So thank you. This concludes the webinar.